Most people think millionaires are glued to screens all day, day trading, flipping crypto, staring at red and green candles like it's a heartbeat monitor. Reality? Most millionaires are painfully nonchalant investors. While everyone else is chasing the next big thing, they're sipping coffee, scrolling their phone, maybe arguing with Netflix about what to watch, and their money is quietly compounding in the background. No secret indicators, midnight trades, or any adrenaline rush. And here's the uncomfortable truth. The investments that look exciting usually make people poorer. So in the next few minutes, I'll break down how millionaires actually invest and how even a complete beginner can copy the same framework without being rich, lucky, or obsessed with charts.
Step 1. They protect money first. Before millionaires think about growing money, they obsess over not losing it. They don't think like racers chasing speed, they think like defensive drivers focused on survival. Seatbelt before speed. Oxygen mask before helping anyone else. In 2025, high net worth individuals hold roughly 8 to 25% of their portfolios in cash and near cash assets, not for returns, but for liquidity. That's money intentionally kept boring, because during market crashes, liquidity is power. When markets fall, most people panic because they need their money. Rent, EMIs, emergencies. Pressure forces emotional selling. Millionaires design around this. They keep emergency funds. They maintain cash buffers. They treat insurance like infrastructure, not an expense. So when volatility hits, they don't sell in fear. They already planned for bad years. They wait or buy calmly while others are forced out. That's the professional mindset. Growth comes later. Excitement comes never. They make sure one bad year doesn't erase 10 good ones.
Step 2. Most of their money is boring. Here's where most people get disappointed. Millionaires don't build wealth with clever tricks. They build it with boring, repeatable systems. US millionaires keep the largest part of their wealth in public equities, and most of that exposure comes from broad market index funds and ETFs, not stock picking. In fact, over half of millionaire portfolios are tied to simple equity exposure, while only a tiny fraction avoid stocks completely. Why? Because boring works. The S&P 500, just America's biggest companies doing normal business, has delivered around 10% average annual returns over the last 30 years. No genius timing or predictions, just consistency. Index funds are the Costco rotisserie chicken of investing, reliable and always there. You don't need a fancy recipe when the basics already win. Think of it like the gym. Millionaires don't chase flashy workouts. They stick to squats, push-ups, and showing up. Boring feels slow, but over time, boring quietly beats brilliant. That's how real money grows, without stress, drama, or burnout. Step 3. They use small experiment buckets. Millionaires don't avoid risk. They just refuse to let risk destroy their life. This is why they follow a simple but powerful structure: a core bucket and an experiment bucket. Roughly 80 to 90% of their money sits in the core. Statistics show high net worth investors keep the majority of wealth in public equities, diversified funds, real businesses, and long-term holdings. This part of the portfolio is built to survive crashes, recessions, and boring years. Then comes the experiment bucket, usually just 10 to 20%. This is where they take calculated bets: individual stocks, private companies, real estate opportunities, sometimes even crypto or alternative assets. The rule is brutal but smart. If this bucket goes to zero, life still works. Rent is paid, bills are covered, sleep is uninterrupted. Wealthy investors don't cap risk with predictions, they cap it with position size. They don't ask, what if this explodes? They ask, what's the maximum damage if it fails? When experiments work, they accelerate growth. When they fail, they educate, not bankrupt. Big base, small bets, controlled risk. That's how millionaires grow without blowing up.
Step 4. They invest automatically, not emotionally. Millionaires don't rely on motivation. They rely on systems, because emotions are expensive. Panic buying at market tops, panic selling during crashes. Most people lose money not because markets fail, but because their emotions do. So wealthy investors remove themselves from the decision entirely. They automate. Just like rent autopay or salary deductions. You don't debate it every month, it just happens. Research shows why this works. Studies on dollar cost averaging prove that systematic investing reduces timing risk and improves long-term outcomes. Vanguard's data shows investors who automate contributions stay invested during volatility, while emotional investors exit at the worst possible moments. Missing just the market's worst days, often caused by panic selling, can massively damage long-term returns. Automation keeps them in the game. Every paycheck, money moves automatically into diversified funds. No guessing, no fear, no emotional headlines controlling decisions. This is why wealthy millionaires don't ask, "Is now a good time?" They ask, "Is my system running?" Because wealth isn't built in emotional moments. It's built quietly, when nobody feels excited at all. Step 5. They hold a long time. This is where the real cheat code lives, not in intelligence, but in time itself. Millionaires don't win by moving fast. They win by not moving at all. Their portfolios are surprisingly low activity. They buy good assets and then let compounding do the heavy lifting. Data shows this clearly. Wealthy investors keep the majority of their money in long-term holdings, especially equities, not quick trades. There's no constant buying and selling, because activity feels productive, but patience pays. Here's what compounding actually looks like. A simple $10,000 invested at average market returns of 10% grows to roughly $67,000 in 20 years. Stretch that to 30 years, and it becomes about $174,000. Same money, same market, only time changed. This is why low turnover portfolios consistently outperform emotional, high-activity ones. Less fees, less mistakes, more compounding. Millionaires understand this deeply. They're calm about the future because their strategy doesn't depend on prediction. They don't ask, "What should I do this month?" They ask, "Will this still work in 20 years?" And that patience quietly does what nothing else can. It multiplies. So here's what this really means for a beginner. Millionaires don't do anything magical. They protect their money first. They invest in boring things that actually work. They take small, controlled risks. They automate everything. And then they wait for a long time. This isn't flashy. It won't give you dopamine. But this is how real money is built. Quietly, consistently, without stress. You don't need insider info. You don't need perfect timing. And you definitely don't need to stare at charts all day. You don't need to be rich to invest like millionaires. You just need to think like one. And if this video helped you see money a little more clearly, share it with someone who needs it. Subscribe, not for hype, but for clarity. Together, we cut through the noise, ignore scams, and move America toward real financial independence. But knowing this framework alone isn't enough. If you actually want to level up, you need two more pieces of the puzzle. How millionaires choose stocks, and the mistakes most people make that silently destroy returns. So if you want to learn how Warren Buffett actually picks stocks, not hype stocks, but boring, high-quality businesses that quietly compound for decades, click the video on the left. In that video, I break down his exact thinking process, step by step, how he filters companies, what numbers actually matter, and how beginners can apply the same logic without guessing or gambling. And if you want to avoid the mistakes that keep people stuck for years, click the video on the right. That video will save you money, stress, and years of learning things the hard way. See you there.